It's a brand new week. Good morning and welcome to Business Morning. I'm Chimeze Obi Iwagu. We kick off the show with updates on the global oil market as prices rose in early morning trade, recouping some losses after Friday's plunge of about $10 a barrel as investors looked for bargains but remained cautious with a focus on the Omicron coronavirus variant and Iran nuclear deal negotiations. Brent crude futures climbed $3.05 to $75.77 a barrel after falling $9.50 on Friday. U.S. West Texas Intermediate crude was up $3.27 at $71.42 a barrel, having tumbled $10.24 in the previous session. Oil prices crashed together with other financial markets on Friday by more than 10%, their largest one-day drop since April 2020, as the new variant spooked investors and added to concerns that a supply surplus could swell in the first quarter. The Omicron coronavirus variant spread around the world on Sunday, with new cases found in the Netherlands, Denmark, and Australia, even as more countries imposed travel restrictions. The World Health Organization said it was not yet clear whether Omicron, first detected in southern Africa, is more transmissible or dangerous than other variants. The Organization of the Petroleum Exporting Countries and its allies have postponed technical meetings to later this week, giving themselves more time to assess the impact of the Omicron variant on oil demand and prices. OPEC Plus will now meet on Thursday instead of Tuesday, when a policy decision will likely be announced on whether to adjust its plans to increase output by 400,000 barrels per day in January and beyond. And over the weekend, the Central Bank Governor, Mr. Godwin Emefiele, said Nigeria's growth has returned to the level it was before it got hit by the global COVID-19 pandemic. Mr. Emefiele, who made this known at the 56th annual dinner of the Chartered Institute of Bankers held in Lagos over the weekend, also highlighted some of the efforts made by the Central Bank and the federal government towards the country's economic recovery. Let's take a listen.
Following the impact of the various accommodative policy measures, our economy made a swift exit from the recession. Unlike the 5 quarters it took to exit the previous recession, the economy rebounded after just 2 quarters of contractions, underpinning the resilience of the economy amidst greater policy support. I'm delighted to note that growth has returned to pre-COVID levels due to the accommodative policy support provided by the CBN and our government. Notwithstanding these positive indicators, our economic growth remains fragile, as our unemployment and inflation rate remains at levels that are not very supportive of growth. Second, continued implementation of our intervention efforts would need to be undertaken to sustain the recovery efforts and stimulate further growth of the economy. Third, given the population growth rate of about 2.7% annually, it is important that we continue to deploy measures that will enable our economy to attain annual growth rate of above 5%. Now, we also do intend to mobilize international capital. A key challenge to supporting the growth in key sectors of our economy is access to large pools of cheap investment capital. Today, over $100 trillion is held by institutional investors in OECD countries, most of it invested in low-yielding assets relative to high-yielding opportunities in Nigeria. And working to tap into this pool of funds will require the setup of an investment framework that offers comfort and security to investors seeking to invest in critical sectors of our economy. As a result, the CBN is working to set up the International Financial Center at Eko Atlantic City in Lagos that will serve as a hub for attracting domestic and external capital, which is needed to strengthen our post-COVID economy. Our International Financial Center, when fully operational in the second quarter of 2022, will help to position Nigeria as a key destination for investment in Africa.
That was Godwin Emefiele, Governor of Central Bank. In the meantime, at that event on Friday, the governor maintained that the banking sector has remained robust and sound, despite the effects of the pandemic, and this is due to prompt responses by the central bank in order to prevent an economic crisis from spilling over into a financial crisis. He, however, says there was some fragilities in the system, but they constituted limited risks. According to him, prudential indicators such as non-performing loans stood at 5.4% in November 2021, while the capital adequacy ratio remained above 15%. Meanwhile, a research and investment bank, AfriInvest West Africa, in its 2021 banking sector report titled Resilience Amidst Endemic and Pandemic Constraints, noted that the banking sector faces a continuous period of uncertainty, and the resilience of the sector would depend on players' response to new developments. To shed more light on this, I'm being joined by the Deputy Group MD, AfriInvest West Africa, Victor Ndokuba. Thank you very much, Victor, for joining us on the program.
Thank you, Chimeze. Good morning.
Good morning. So every year, AfriInvest reports on the performance of the Nigerian bank, and this year your report seemed to corroborate central bank's stance that the banking sector remains resilient amidst the pandemic. So what for you were the key factors that shaped the banking sector landscape in this year?
Thank you again for having me, and it's my pleasure to be here. This year's AfriInvest annual banking sector report x-rayed the performance of banks, vis-a-vis the context of the broader economy and the challenges that continue to ensue, particularly from the impact of COVID and what it did in terms of shutting down the economy. Prior to COVID, of course, we still had, lingering endemic issues with the economy, specifically around inflation, unemployment, and the persistent issues with the FX supply and liquidity and all of that. But I think, by and large, when we look at the performance of banks coming into 2021, we see what we term to be resilience, and what does that mean? Essentially, it's deriving from the performance of banks, despite myriad challenges, that ensue or that they continue to face. On the economic front, you have issues with growth, low levels of growth. We had a recession that obviously didn't last too long, thankfully, 2 quarters, and we rebounded fairly strongly. And thankfully, banks were able to very quickly adjust their loan books as well, restructuring in some cases, tenors, and in some cases allowing certain forbearances, which allowed businesses to sort of get back on their feet. Overall, when we then, put that side by side, the fact that, COVID continues to be a clear and present danger. Only just last weekend, we've heard about the emergence of Omicron, a new variant that, while still being studied, suggests that it's a bit more infectious and perhaps a bit more, severe in its impact. But overall, we think the banks have performed fairly well when we just put it side by side, the challenges that continue to bedevil the economy. All
right. Now, taking it from, where we're coming from, 2020, I remember one of the measures taken perhaps to improve the flow of credit to households and businesses during this pandemic. We saw the MPR being reduced from 13.5% to 11.5%. And of course, there was an increase on the CRR from 22.5 to 27.5. And over time, we've seen banks, complain about the frequent CRR debit. That's one regulatory issue that seemed to have bedeviled the bank during the period. And of course, there's also this 65% LDR.
Loan to deposits.
Yes. So how much impact did this policy, from the central bank, how much impact did it have on the bank's ability to actually give out credit, which is one of the reasons that the central bank actually came up with that policy?
So thanks. You're right. The question, frames it as something that has, evoked a bit of complaints from within the banking quarters, and rightfully so. But be that as it may, when we look at the overall performance and we look at the banks, using the I think, a list of 15 banks which are listed as a proxy for the sector as a whole, we find that loans grew in double digits, I think, almost 15%, thereabouts. And on the back of that, however, while income from loans slightly declined compared to 2020, coming in at about 1.1 trillion in total, we find that the challenge with that, obviously, is the fact that the extension of credit, whilst growing up in absolute terms, did not quite translate into increased income for a number of reasons. Already we talked about the fact that coming from 2020, there was lingering issues with companies who, having to have shut down for several months at a time, were struggling to essentially grow their performance in terms of reported revenues, in terms of operating stats, income levels, EBITDA and things like that. So the ability to service loans was challenged, and so banks, proactively restructure some of those loans. What we also found that by virtue of the amount of liquidity in the system, the overall yield in the environment also declined. So what it meant was the pricing for loans also declined comparatively to the earlier years. So while loans in total, in terms of the volume, was up, the income from those segments were slightly down. Now, how the bank offset for this? We also recognize that because of the impact of COVID and what it did to restriction of movement, lockdowns and, social distancing and all of the other isolation measures, there was a widespread increased levels of adoption of digital channels and alternative means for banking. So we saw a significant rise for virtually all banks in terms of adoption of digital channels, using things like mobile apps, USSD banking and ATMs, or even in many cases POS banking. Now, what has that done? It meant that the flip side is that on the sort of fee and commission income side, we've seen some upside for some banks. Now, not all banks enjoy that benefit anyway, because while the volumes overall were up in many cases 30%, 50%, in some cases 25%, income levels also did drop because, again, the competitive landscape meant that they had to be price sensitive and adjust for some of that. But overall, when we then put that side by side, the sort of investment income that comes from yield, we find that on balance it's fair. What the CBN sought to achieve with some of those policies, especially the loan-to-deposit ratio at 65%, was to force the hand of banks, towards lending as against just playing on treasury, which is playing around with investment income. Now, how beneficial has that been? In many cases, you find that whilst there's a desire to lend, the challenge on the flip side is that corporates are also not very keen to extend themselves in a period when there's a lot of uncertainty around the market. As you may obviously be aware, inflation has been quite high. Thankfully, it's been declining for, it's going on 9 months now consecutively, but it's still very high, double digits, coming down from nearly 18% to right now just under 16%. But what that means in everyday terms is that the average person is struggling to purchase services and goods, especially things like food, staples, because prices have gone up so much so that people are spending a lot more of their purse on some basics like feeding, and what that means is that there's not a lot of money available on other things, so disposable income has come under a lot of challenge because of inflation. The exchange rate itself also continues to create a feed-through effect, in some cases, again, for certain elements of imported items, and therefore imported inflation as well comes under pressure. So when you put all of that together, you see that while banks want to lend, there is not as much appetite from businesses to take on credit because they're not quite sure that whatever they take the credit to fund in terms of activities of manufacturing would feed through
with
the market.
this CRR now still remaining at 27.5% and we have the LDR at 65%, what does that mean for the banking sector going forward? And from AfriInvest's perspective, if the central bank should actually act on this, what is more appropriate?
So ultimately, the central bank, retains the exclusive preserve to manage monetary policy, and those two ratios fit squarely within its remit. The cash reserve ratio essentially is a ratio that the CBN uses to determine how much of each single deposit that comes into the bank is retained by the banks in the CBN's vaults. So at 27.5%, it means that for every 100 naira that comes through in deposits, 27.5 is held in an account to CBN that earns 0 or next to 0. So in effect, it's called sterilization. So what it means is that the banks are therefore required to earn income on a fraction, just nearly 70, just under 70%, about 63% of whatever income, of whatever deposits they've taken. So that puts them first under pressure. Of course, there is the loan to deposits, which then sort of speaks again to the total liability or ability of the banks to mobilize deposits, because a deposit is a liability to the bank. It's money that depositors have as a claim whenever they show up and say, you know what, I need my cash. So in effect, it's shrinking the space for banks to maneuver, you know, and what it means is that the banks have had to be innovative and creative, you know, in order to survive. Now, looking forward, when you talk about what's the outlook, I think the fact is they've proven to be resilient. You know, the last 2 years particularly have shown that Nigerian banks are resilient, and if we look back over the last 2 decades, they've always proven that they're resilient. And so the outlook is that, yes, while we expect that there will be persistent challenges, because we don't see that a lot of the more broader macro issues would disappear overnight. We still have issues with inflation. We still have issues with unemployment. The exchange rate continues to be challenged. You know, growth is, while it's rebounded strongly in Q2, it remains largely anemic, in that when we look at long-term growth over the last 6 years, we've averaged less than, you know, just about 2%, you know, in terms of GDP. So looking forward, we expect that the banks would continue to be resilient. We expect that there will be growth in loans. We expect that there will be growth in deposits. Where we think there might be a challenge, however, is in terms of income levels. I think on our estimates, we think on average you'll grow about 5.2%, you know, between now and 2022, for example, in terms of PBT. Revenues will be up right about the same sort of mark, you know, compared to double-digit growth on the, you know, asset side.
Now, how well capitalized are the Nigerian banks?
Nigerian banks are actually quite adequately capitalized. If we use, for example, the requirements of Basel III, which requires the banks to hold at least 8% of their you know, total risk-weighted assets in capital, we find that on average Nigerian banks are holding about 19.7%, you know, capital adequacy ratio, which is quite comparable. In fact, it's much better. It's almost twice the levels, more than twice the levels required by Basel. Although when we then compare Nigerian banks to African peers, for example, Egypt and maybe Ghana, we find that they're just slightly off. I think Egypt is at 21.7%, Ghana is at 20.2%. But those numbers really, what it says is basically the banks have the capacity to absorb losses, you know, if indeed they do arise. That's what the capital
at this point,
remain.
should we actually be talking about recapitalization or consolidation?
So a recapitalization may not necessarily be in the works in that sense, unless, of course, we were trying to sort of rebase our capital levels in dollar terms. I think when I think back to the time when you know, the former CBN governor, Charles Soludo, set up the recapitalization, there were certain benchmarks in mind at the time in terms of dollar levels for what would be licenses for banks to operate. Given where the Naira has gone since then, you know, when it was about 120, 130 to the dollar to where it is today, you know, again, depending on what rates you look at, the official at 413 or, you know, parallel markets, you know, north of 550. You can see that in dollar terms, the absolute size of Nigeria's bank's balance sheet has shrunk. So from that perspective, there might be a case to perhaps recapitalize. But again, when we look at how much of the bank's earnings have been retained in the form of retained earnings or, you know, profits that are held back and, you know, reinvested into the business, you know, a good number of the banks are quite adequately capitalized. And I don't think there's a challenge there. What we may find, however, is a consolidation from a strategic standpoint where some banks might choose to undertake some inorganic type transactions, you know, through acquisitions or mergers to further consolidate their areas of strength and position themselves better in the market. So those are the kind of things we might see going forward.
Kind of mergers and acquisition? Okay. Thank you very much, Victor. We do appreciate your time on the show. So we look out for better banking sector environment come 2022, I guess.
Thank you very much for having me.
Victor Ndukoba is the Deputy Group MD at Afrinvest West Africa. We'll take a break now. When we come back, we'll look at the politics of subsidy removal and its implications. Do stay with us.